Okay, so the next lecture is called Refinements, and instead of going through the whole lecture, I'm just going to summarize it. Alright, so there are a couple of key things he wants you to know in the Refinements lecture. The first is terminal shakeout, second is ordinary shakeout. Alright, these are the bull moves before a move higher. So these are shakeouts before a move higher. They're known as terminal shakeout and ordinary shakeout. Then there is something called a thrust, which is basically the bear version of a shakeout, meaning after the shakeout occurs, the market goes down. Instead of calling it a shakeout, he calls it a thrust. Because it's bearish, he just calls it a thrust. And then the other thing is a rally from an oversold condition. This type of behavior. And finally, something about bases that I'll get to. That is right over here. It's called 5 is trading range versus accumulation. So this is the fifth behavior, is trading range versus accumulation. This is the danger of using bases without understanding whether they're bases or trading ranges. But basically, the importance of using the vertical chart with volume along with point and figure. Not every formation is accumulation distribution. So these are the 5 things you need to know from this chapter. So anyway, let's go over the first one, is the terminal shakeout. I don't want to go towards too many examples of this, but basically you got a base, it goes down, then it goes right back in the base, and then markup ensues. You want to see an example, take a look at election night with Donald Trump. That'll show you a very clear terminal shakeout before markup. So that's a very, not that recent, but fairly recent example, very clear example. But basically you have a base, you have what seems like a breakdown, but it's not a breakdown, it's a shakeout. You have a reversal back up, and then you have markup. Okay. Now, a terminal shakeout is a rapid or precipitous down movement occurring at or near the end, that's the key, end of a period of preparation for an advance. So it's the final drive down to get rid of anybody. Just make sure there's no one in, and preparation for an advance. Think of it as a base. Looks like a breakdown after a base, but it isn't. It's a shakeout followed by a reversal back into the base and a move higher. So you have to be really careful with this type of maneuver, because it looks like a breakdown, but it's not a breakdown. It's a shakeout to go higher. And one of its qualities is that there's a period of accumulation. So the base has characteristics of accumulation. And then when it goes down, it goes up most of the time pretty quickly. Meaning that's the nature of the shakeout, is it goes down and then just comes right back up. Alright? So that's terminal shakeout. Again, just think of a base, sideways base of accumulation. And towards the end of that base on the right hand side, you have a move down, you have a quick move up, and it goes into markup. Second is the one I want to focus on and give examples, because it's much more common. The second one, it doesn't have extensive preparation, but it does usually have some type of climax. This climax is, for example, in 2 forms. One is an exaggerated climax, and the second, which you'll see very often, is a minor climax. So let's take a look at exaggerated climax. As you can see, this is one of the first studies where you have the market going down, 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 and then it really expands. It really expands at the bottom of the wave. So this is what a shakeout, a type of shakeout is. It is a selling climax, but it is also a shakeout, and it fits the definition of an exaggerated selling climax. So you can say a selling climax is a type of shakeout, okay? Especially if it's exaggerated. The second one is a minor selling climax. So the first one is obviously a major, right? So you can call it exaggerated or major, whatever. But this is a shakeout. Second one is a minor selling climax. This you will see on the pullbacks. You have 1 bar, 2 bar, 3 bar, 4 bar, and then bang! Fifth bar expands in range and in volume. And this is a minor selling climax. Why? Because it terminates a reaction. It terminates a pullback. It rallied, then it pulled back. This pullback terminated the pullback. And then you had a little shakedown right here and a reversal back up. But that is your key. It's basically ending the pullback. Alright, and since it's a pullback, not a major trend, it's known as a minor selling climax. And this climax is also known as a shakeout. Okay, and if you're wondering where I'm getting this from, go read the section on refinements and you'll come to the same thing. I'm not making any of this shit up. Alright, so now we move on to thrust. Now this is a little bit interesting because a thrust is the opposite of a shakeout. It's not the opposite of a shakeout. It's just the bearish version of a shakeout. Okay? And the definition he gives is a sharp run up into an area of distribution or a temporary bulge to the top of a trading range, which fails to hold, and this he calls an upthrust. Okay, now the thing is, the upthrusts it's used in different ways. The high to high of a wave is also known as upthrusts, or the bar to bar. The upthrusts are shortening, meaning the highs of the bar to bar to bar, like over here. So this term upthrust is also referring to the thrust from high to high. Alright, when just describing bars that are going up. So when you're describing bars that are going up and you're trying to measure progress from high to high, you say in Wyckoff terminology the upthrusts are widening or shortening. But here he uses the term upthrust as differently. Okay, what he's trying to say is that it is a shakeout. So what he says is it goes up and then it comes back down. It fails to hold. Okay? And here is the example. This bar right here is your upthrust. It is also a shakeout. It has the volume, it has all of that, and you will also note that this is also a type of minor buying climax, because shakeouts, what I've seen so far in almost every case, is their type of climax, either from the perspective of price or volume, wide ranges or volume. They have this characteristics of a climax. So here you have a buying climax, which is also a shakeout. Okay. Okay, now one more example. This is the one I just showed. Here you have another example where it's on top of a rally. Now, usually they're on top of the rally or a few bars right after, and they pop up like that. So here you have an example of a two bars which together form the upthrust. It fails to hold. It goes up, it fails to hold, it goes down at the top of the range. Now you're asking, like, why is this an upthrust? It's not a type of climax. It doesn't have the high volume characteristic. That's true. It doesn't. But understand that here you do have high volume, and here as well. And in this study, basically it said the public was getting in here. And it also said that this is selling, this is the biggest red bar in the trend that started from here. So this I would consider a change of behavior right there. And later on, you have that pop up and then right back down. That behavior of popping up and coming right back down with the selling in the background and the public getting in qualifies this move together as an upthrust. The other one, that's on top of a range, right? On top of a bulge, on top of a rally. So as is this, is also on top of a rally. The difference is, this is a red bar, high volume, all done in one bar. Here, it's done over two bars, does not have high volume on the bars, but does have it in the background. Okay. The other example is right here. This is actually with trend, right, within a downtrend, not on top of a rally within an uptrend, but instead on top of a rally within a downtrend, where the move here pops up, right, and immediately is erased. This also qualifies as an upthrust from pure Wyckoff standpoint, where he used the term upthrust as a form of a shakeout. Okay. He also synonymously termed upthrust as something else. He called it as a thrust movement, upthrust, or perhaps a terminal markup, which basically means it ends markup. How does it end markup? It ends markup up here for this rally. It ends markup right here from this rally. Right, but the way I rather see it is just it's a type of buying climax because it's much easier. With too many terminology, you go crazy. So in this case, it's very easy to see it as a climactic move. In this case, it's basically, it just jumps up and jumps back down, erasing the day's gains. This is hard to call this a buying climax though, right? Because it doesn't have high volume, so I don't know what to call it other than just an upthrust, thrust up, thrust down. Same here, thrust up, thrust down. The key being, it goes up and the entire day's gain is erased. See? Pop and drop. Alright, now it can be on top of a rally or a bulge, or it can be something like this, which is with trend, where it's a minor corrective move and a reversal. And it can be one bar or it can be two. It can have high volume on the bar, or it doesn't necessarily need to have high volume on the bar. It can instead be something like this. Okay, but I like it when it has high volume, because especially in that case, you know they're selling the high. In this case, it has selling in the background and then pop up, pop down. But if it doesn't have high volume, just look at whether the entire day's gains is being erased. Okay, so I think I've done that enough justice. Moving on. Here you have a sharp rally example. So in this example is a sharp rally from oversold area. In this example, you had a move that was going down, 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 down. initially there was some support that developed here, and there was a base like formation like together, but it just kept going down, and then finally the base was very clear here. Okay, now the thing is, with point and figure charts, over here it rallied. Okay, it rallied from here. Now the people will take this area and do the count. They'll say, oh, okay, this is there 1 2 3 4 5 6 7 8 9, so it should go up 9 points, but it goes up much further than that. The reason being is there was, I don't know what to say, pre-demand or pre-accumulation or preliminary demand. Yeah, preliminary demand. So preliminary demand was actually here. So what he's saying is they actually started buying here on preliminary demand here, and the rest of the move is just going lower, but they're actually accumulating on the way down. Okay, smart money, they started here, but moved it down and accumulated and then rallied upwards. So he says this range here from the, you see with the up arrow and the down arrow, this entire range was accumulation, and that area where the up arrow is a zone of support. Okay, and he also says there'll be times, this was a bear market, that you will run into a case where the cause is much less than the effect. In that case, you really want to see if there's any other indication that is very important. For this market, what was important was the trend line. This was a long trend line in a bear market which was broken. That was what he called the significant piece of this puzzle, a significant behavior or something, was the break of the trend line and the ability to rally on heavy volume. Okay, so that was, I think, maybe the first time or something like that this trend line was finally broken in a bear market. And he also indicated that over here was early preliminary demand or preliminary accumulation, and they accumulated all the way down and then went up, and the cause wasn't down here, the count wasn't down here, it was actually from the higher zone of support across this area, as you can see in the green box. So this means is be careful with your point figure, and it's something that for sure will just be observed and learned over time. And finally, he mentions this chart and says, don't just use point and figure by itself. If you use point and figure by itself, there's a lot of point and figure chartists, if you use point and figure by itself, you will be misinformed. He says that people were looking at this and saying, oh, this is a beautiful base, because they're looking at the point and figure by themselves, and that is the first mistake. The charts must be used together. And he says that in this, people were looking at this base and saying it's a beautiful base for a rise. But what they didn't look at was that in this base on the vertical chart, every time the market rallied, the force of demand was met with the force of supply, which rejected it. So here on this attempt, you see the high volume and you see a shakeout or like a reversal or whatever you want to call it. The force of demand met the high volume force of supply, and the market went down. Then when it went back to that level again, bang, high volume. The force of demand met the force of supply, and it puked. Then it went up again, and the force of demand met the force of supply. See the low end close. Then it did it again, and the force of demand met the force of supply. And then eventually, every time it rallied here, and here, the force of demand met the force of supply, which sold the rallies and eventually broke it on increasing volume, as indicated here on this break. So if you just look at the base, you think, oh, this is accumulation, it goes sideways, it went to support, then rallied, it went sideways, went to support, then rallied. This looks like a triangle. If you draw stupid lines from here to here and here to here, it looks like a triangle or whatever it is. But if you look at the look at the chart and look at the volumes, you see all volumes were rejected by the force of supply, meaning the force of demand on heavy volume, meaning they were sold. The levels was sold. Selling came in and then broke it. Therefore, what was happening was supply was neutralizing demand. When supply neutralizes demand, you have ranges. And those ranges look like bases, but they are not bases of accumulation, they are just ranges. When the force of supply meets the force of demand, you have a range, or you have equilibrium. It is not accumulation, it is not distribution, it is equilibrium. And to think that it's a base is an error. So to avoid making this error, you use the P&F chart and you verify whether it's accumulation or not by using the vertical chart and looking at the price volume characteristics and seeing if they match the behavior of accumulation. The behavior of accumulation is not to sell the rallies. That is what's going on here. Rally sold, rally sold, rally sold, and rally sold. This is not accumulation. It is not dull activity in a tight range, holding support and continuing to go to support. Instead, these are high volume rallies that are being rejected and sold. And therefore, the base that you see at the top here is not accumulation. It is nothing more than a trading range in which the rallies are being sold and the force of demand is being neutralized by the force of supply, and eventually the force of supply wins and breaks on increasing volume, and the trend continues down. And that's all, folks. So this is a quick summary of the section called refinement, which is I don't know what, section 20 something in the Wyckoff course. Alright, take care, bye.